You have $10,000. Where do you put it? A savings account, the stock market, real estate, crypto, or your brother-in-law's startup. Most people make this decision based on what they heard at a dinner party, what a YouTuber was paid to promote, or what their parents did 30 years ago. Today, we're doing it differently. We ranked every major investment type, from the absolute worst to the strategy that has made more ordinary people wealthy than anything else in history. No hype, no sponsored picks, just the math. Let's get into it. Before the ranking, here's how we scored each investment type. We evaluated 3 criteria. 1. Return. How much does it actually grow your money over time? 2. Risk. How likely are you to lose what you put in? And 3. Accessibility. Can a normal person with a normal salary actually do this? We're ranking for the long game. 10, 20, 30 years. We are not here for people trying to get rich in 6 months. If that's what you're looking for, this is the wrong video. But if you want to actually build wealth, keep watching. Rank number 8. Savings accounts. The trap, dead last. The average savings account in the U.S. pays around 0.5% interest. High-yield savings accounts can get you 4 to 5% right now, which sounds decent. But here's the real problem. Inflation averages 2 to 3% per year over the long run. Your safe savings account is barely keeping pace, and in normal rate environments, it doesn't even do that. A savings account is not an investment. It is simply a waiting room for money you are about to deploy elsewhere. Use it for your emergency fund. Nothing more. Rank number 7. Bonds, the safe bet. That isn't. Bonds are loans. You lend money to a government or a corporation. They pay you interest and return your principal at the end of the term. They're stable. They're predictable. And for most individual investors under 50, they're too slow. The 10-year U.S. Treasury currently yields around 5.5%. Better than a savings account, yes. But over 30 years, the stock market has historically returned 7 to 10% annually. Bonds simply cannot compete with that over long time horizons. Bonds belong in your portfolio when you're close to retirement and need to protect what you've built, not when you're actively trying to build it. Rank number 6. Individual stocks, the gamble that feels smart. Picking individual stocks feels like investing, but in reality, it is much closer to gambling, unless you're willing to do the work that almost no one does. The data is brutal. Over a 15-year period, roughly 92% of actively managed funds, run by professional analysts with teams of researchers, failed to beat the S&P 500 index. If professionals with full-time resources can't beat the market, what are your odds of doing it while picking stocks on your lunch break? That said, individual stocks aren't useless. Buying shares of companies you deeply understand, holding for decades, and reinvesting dividends can work. Early investors who put $1,000 into Amazon turned that into $1.6 million. But for every Amazon, there are 100 companies that went to zero. Proceed only if you're prepared to do serious research and watch your investment drop 70% without panicking. Rank number 5. Direct real estate, the empire that costs you. Real estate has made more millionaires than almost any other asset class. That is the truth. But here's what the real estate influencers don't tell you. Being a landlord is a second job. Broken boilers at midnight, tenants who don't pay, vacancies that kill your cash flow, legal costs, maintenance costs, and property taxes. And the entry barrier is enormous. A down payment on a rental property in most cities requires a minimum of $30,000 to $80,000. That said, the fundamentals are incredibly powerful. You have leverage, rental income, appreciation, and massive tax advantages. If you have the capital, the patience, and the stomach for it. Direct real estate builds real wealth. It's ranked number 5, not because it doesn't work, but because it doesn't work passively. Rank number 4, REITs, real estate without the headache. A REIT, or Real Estate Investment Trust, lets you invest in properties without ever having to manage them yourself. You buy shares in a fund that owns hundreds of commercial properties, apartment complexes, shopping malls, hospitals, or data centers. By law, they are required to pay out 90% of their taxable income as dividends. The average return for REITs over the past 25 years has been around 9.5% annually, better than bonds, less volatile than individual stocks, and genuinely passive. The downside is that they are highly sensitive to interest rate changes. But as part of a diversified portfolio, REITs are one of the most underrated tools for building passive income. Rank number 3, ETFs, the flexible powerhouse. An ETF, or exchange-traded fund, is a basket of assets you can buy and sell just like a single stock. Want to invest in the entire U.S. stock market? There's an ETF for that. Want to track gold, bonds, semiconductors, or clean energy? There's an ETF for that too. The S&P 500 ETF, with the ticker symbol SPY, has returned an average of about 10.7% annually over the past 30 years. If you had invested $10,000 in the SPY in 1994 and never touched it, today you would have roughly $200,000. ETFs combine diversification, low fees, and liquidity. They are flexible and require zero expertise to buy and hold. The only reason they're not in the number one spot is because something even simpler and more powerful exists. Rank number 2, index funds, the wealth machine. Index funds and ETFs are close cousins. The difference is mostly structural. What makes index funds legendary is their philosophy. Instead of trying to beat the market, you buy the market. The Vanguard Total Stock Market Index Fund has returned approximately 7.5% annually after inflation over the past 30 years. Not because of genius stock picking, but because it owns everything. Warren Buffett, widely considered the greatest investor in history, has consistently said that most individual investors should simply put their money in a low-cost S&P 500 index fund and leave it there. He even put this in writing in his will. He has instructed that 90% of the cash left to his wife be invested in a low-cost S&P 500 index fund. If that is his answer for his own family, it probably deserves your attention. Rank number 1, automated index fund investing. The Apex strategy. The number one investment strategy isn't a secret. It isn't complex, and it isn't exciting. That is exactly why most people never do it. Automated, consistent investing in a low-cost global index fund. Here's what this looks like in practice. You open a brokerage account. You set up an automatic transfer of $200, $300, or whatever you can afford, on the same day every month, right after your paycheck hits. You invest it into a single fund, a global index fund that tracks the entire world market. You don't watch the market, you don't try to time it, and you don't change your strategy when the news is scary. You do this for 20 years. This strategy works for 3 reasons most others ignore. First, dollar cost averaging. By investing a fixed amount every month, you automatically buy more shares when prices are low and fewer when they're high. You don't need to time the market. Second, compound interest. The returns on your returns generate their own returns. After year 10, the curve bends upward sharply. After year 20, it goes nearly vertical. And third, behavioral protection. The automation removes your emotions from the equation. The biggest enemy of the average investor is themselves. Panic selling in a crash or greedily chasing a bubble. Automation fixes both. Let's look at the math. $300 per month, 8% average annual return for 25 years. The result, $270,000. From just $90,000 invested, $180,000 generated entirely by the strategy itself. This is not a get-rich-quick scheme. It is a get-rich-slowly scheme, which is the only scheme that actually works. Here's how to implement the number one strategy this very week. Step 1. Open a brokerage account. Platforms like Fidelity or Schwab have zero account minimums. Takes 10 minutes online. Step 2. Search for a fund like the Vanguard Total World Stock ETF or a similar low-cost total market index fund. Step 3. Set up an automatic monthly investment. Start with whatever you can, $50, $100, or $300. The amount matters far less than the consistency. Step 4. Set a calendar reminder for 1 year from today to review. Not to change anything, just to review. And Step 5. Close the app and go live your life. That's it. The strategy is boring by design. Boring is how it works. If you want to see how this strategy has held up through every major market crash in history, from the 2000 dot-com bust, the 2008 financial crisis, to the 2020 crash, subscribe. Because that's exactly what we're covering next week. A quick spoiler. The people who stayed the course came out richer every single time. Like the video if it helped. It takes 1 second and it means everything for a channel like this. See you in the next one.